imagine a company where you give them a bad store of value where they have to get rid of the money as quickly as possible and what that impacts the founder in the decisions that they got to go make versus you give founder money that doesn't lose its value. Like that is a complete 180 in terms of how they're actually going to go build higher scale. And I think when you start to kind of look at how that's been different from the last 10 years of venture capital and what we're going to look at going forward, you're going to see a dramatic change in overall size.
Hello, everyone, and welcome back to Bitcoin for Professionals with myself, Haris Irfan, and my co-host, Ralph Gibran. Today, we've got Brad Myers, who is a partner at Early Riders. And Brad, we're going to dive straight into this. You've been in venture capital for a while and seen some trends come and go. What do you think? Is Bitcoin truly revolutionary, or are we still in the early innings of proving its case?
Great to be here, Ralph Harris. Excited to be speaking with you all today. Jumping directly into the first question here. So I think it depends on who you ask. For someone who is, part of a venture capital firm that is denominated in Bitcoin, we measure our returns against Bitcoin. We believe that, Bitcoin is truly revolutionary. And it is something that's going to change the overall framework dynamics, foundations of whether it be private capital allocation, even public capital allocation. But at the end of the day, it is early innings for those that ultimately understand the asset class, and it's very early innings, and it's not even on the radar for many traditional allocators that are stuck in more of the traditional allocation mindset. And so, from our seat, we find that there's an incredible amount of alpha and advantage from where we sit because we've personally been allocating to Bitcoin for a number of years, and ultimately we're starting to apply those techniques and ultimately those strategies when it comes to using Bitcoin's use cases within the capital allocation space and ultimately business building. So for me, it is completely revolutionary, and we're in the early innings. So it's an incredibly excited time to be looking at companies, talking with potential LPs, prospective LPs, current LPs, and looking at deal flow. It's quite a shift in what the past 15 years of the investment space has been.
Yeah, very much so. I mean, what do you think would have to happen for Bitcoin to become undeniable, an absolute must-have for institutional investors?
It's a really good question. I think for where we sit today, institutions have, again, even mandates. So there's a lot of, I'll just call it, in the technology space, we have something called tech debt. And that's really where organizations and technology companies are having to go rebuild technology stacks to get to that next we'll call it wave of opportunity or addressable market. And I would even say that where we stand today, we have a lot of financial institutions that have legal debt from the way that they're structured and the way that they're required to go allocate capital. And so I think there are some handcuffing that occurs for these institutions. I think as we start to see more and more companies and really institutions start to adopt the asset in the sense of viewing it as a part of a normal portfolio and not having to go outside the box and getting creative on how to go allocate to the asset class. Because I think a lot of institutions want to go allocate. They see the value within it. But instead of them having to go create special purpose vehicles or, again, come up with some funky, micro strategies, been able to take big advantage of this, going after various types of, again, issuances. So various institutional allocators can get access to whether it be Bitcoin, again, just exposure. That will take time for those that legal debt to ultimately be eradicated and really pushed out to be like, what, ultimately this is going to either be a part of the broader legal construct of how we ultimately protect the investors that we represent or the fiduciary responsibility that we have. And so I think, again, that's a huge hurdle to get over. But at the same time, when you start to go look at, compounding CAGRs and things like that, it becomes very undeniable from anybody that's held the asset or has had exposure to it, that it really is a requirement going forward with the way that fiat currencies are continuing to accelerate in debasement and ultimately capital destruction across the board. And we'll get into some of those points a little bit later in the discussion.
Yeah, thank you for that, Brad. So right off the bat, we got into Bitcoin VCs, but let's take it back a little bit. And maybe, this is a Bitcoin for Professionals podcast. And full disclosure, Brad is a good friend of mine, and I would call him a hyper professional. So, Brad, maybe you can give us a little bit of an arc about your professional journey before you got into early riders, Bitcoin venture capital, so people can learn a little bit about your background and where you come from.
Absolutely. And Ralph, very much neutral. Enjoyed getting to know you through our work at OnRamp Mina. Um, yeah, so I was a product of coming out of college during the financial crisis. So I think when we look at signposts, that's obviously one that's very obvious to me. I was a finance major, and when you kind of came out of school, there was nothing that you could really do about the shape of the world. It was interesting though to be in the seat of a student, hearing what you know our professors and lecturers were actually discussing on what was happening within the world. I think that kind of changed when none of us were really able to go again secure what the normal job flow had looked like for the last 10 years for graduating college students. And so again, we just look at signposts that really impact your career. I ended up starting my career within corporate finance in Chicago, and then ultimately started an apparel business that worked within licensing for destination retail brands. And so I had a close friend of mine. We built that business up. And I think ultimately that was really built out of the fact that um, no one really knew what they were doing. That was kind of, again, kind of like the aha moment for me, at least on, building a career, learning skills. The moment you actually take the initiative to go start, sticking your nose in places and building a business, you really start to, again, have the building blocks of, um, the fact that it's just problem solving and again chomping down on your tasks list day in day out to go ultimately build a company. And so that was a great experience. I ended up selling out of that business and going to graduate school with the goal of landing at a large firm to go learn big business. I think very quickly when I graduated, I ended up at Deloitte Consulting. Had some great experiences there, but had realized that really business building was what I wanted to get back to. And so when I was at Deloitte, I spent time in the strategy and operations consulting division, but then ultimately ended up in corporate development, looking at a variety of different investment opportunities on behalf of senior leaders at the firm. And so it was an entity called Deloitte Investments, highly regarded within the firm, and yeah, learned a ton of just about more traditional, we'll call it, corporate development, M&A work. And then went on to leading technology companies and teams and natures like that. So really was on the revenue side. So got the chance to work with an automotive, enterprise marketplaces, SaaS, a variety of different companies. But Bitcoin was there kind of really all along. And again, that's when really I started my journey on really what is money. And was able to seize capital destruction at its finest across various venture capital firms that were backing these companies, even publicly traded. Um, and I think ultimately, it poised me to take a little bit of time off in 2022, 2023, and was fortunate enough to land in the Bitcoin ecosystem. And Michael and I had met, Michael Tanguma, co-founder and CEO of OnRamp. We had met years ago, and we had decided that there was a better way to do venture capital within Bitcoin, and hence the Early Riders was born. And it's been a great journey since.
Amazing. Was there a specific aha moment? I know you gradually, it seems based on your career journey, found yourself in Bitcoin, and you mentioned capital destruction. But was there a specific thing? Because you've clearly worked across a variety of industries, across a variety of roles, corporate finance, TradFi, technology, consulting, and it's quite fascinating. Not a lot of people get to see, multiple industries. Myself, I've been in finance my entire career. Literally, that's all I've known. And then I got into Bitcoin, which in a way is also close to finance, but you've seen a lot. And was there a specific aha moment that you can pinpoint? Like, what was the thing that made you think, oh my God, I need more Bitcoin, and then eventually I need to work in Bitcoin?
Yeah, I think there's kind of two angles that I approach this from. So I think when I really first started to learn about self-custody, I think that was a very powerful moment. And I would take that more on like I think, more libertarian kind of viewpoint. Where, hey, if everything went sideways, I could put 12 words in my head and go walk across a border and hold my wealth and trap that wealth in my head, protect my family, my wife. Um, and that was a very aha moment for like, wow, this is really powerful stuff. Because like you don't, when you think about again technology, there's that zero, those 0 to 1 moments. Again, I remember a world before Uber and being in Chicago and having to hail a cab, late in the evening, and you might not be in a place where a lot of those are around. So like the moment that you saw these apps start to pop up, it was like, wow, that's amazing. Like it's almost like magic. It shows up, and then all of a sudden, this asset comes across where all of a sudden it's like, wait a second, I don't have to trust the bank. I can put it in my head and store it, and then walk across the border, and no one knows that I can do that. Or again, they can't necessarily you can take that away from me. So there's obviously a lot of like I'll just say risk along with that as well. But there's also a lot of power, and so I think that was more like the libertarian kind of like mindset of learning really about how to be self-sovereign from that perspective. I think more in a more professional sense. Um, Really, my aha moment with Bitcoin was just seeing its ability to just be better money and how that impacted me personally. And again, my again financial allocation strategies. And when I looked at the companies that I was working at and comparing again how Bitcoin would perform relative to that, it really started to just anchor to the fact that this is better money, and better money has broad impacts for the individual or for a company, and looking at again relative performance. And so looking at my relative again performance in Bitcoin from just simply again stacking Bitcoin, realizing it's a better store of value, and looking at the relative performance of the companies I was working at, putting in long hours, again, and everything that comes along with that. If you're a shareholder of a publicly traded company, you're seeing again the market evaluate your company mark to market every single day. And when I really looked at Bitcoin, it was like, what, really, to me, the fundamental unit of account that we value our entire world is fundamentally flawed. And so that was some of the best trades I made. I was at a publicly traded company at that point in time, and I the moment those shares would vest, I would again load those into Bitcoin because I just saw that as a better store of value versus again what I was putting my day in day out work on, where my paycheck came from. I viewed that this was a better asset than what I was doing, and that really started to get at least me much more focused on thinking through how does Bitcoin ultimately become a broader portion of an investment portfolio, or ultimately the foundation of how people need to evaluate investments and ultimately go build companies.
So you've conceptually made the leap into putting Bitcoin first. What about professionally? I mean, there's one mental hurdle, which is, okay, now I have a Bitcoin first mindset and it accords with my values, and they may tend towards libertarianism, for example. What about professionally when you're shifting from TradFi into a Bitcoin industry? How do you achieve that shift?
So I think it's a lot of folks go through this when again they kind of really start to go down the what is money train, or like avenue. And I think ultimately seeing Bitcoin play a very important role in my life, viewing at like how I viewed the cost of capital for my every personal decision that I made. And thankfully I have a very supportive wife who also has seen the benefits of it. Again, she was one of those individuals that put her Trump check 100% into Bitcoin and was able to see again that kind of positive feedback loop. And so then when it comes to professionally, all of a sudden there's two things that start to happen. Number one, you go, okay, hold on a second, like storing my value, my excess productivity in this better store value asset class, which is Bitcoin. So whatever you don't spend on a monthly basis, it goes in there. Ultimately starts to buy you time in the back end. So all of a sudden you start to think through like, I can actually go work on things that I am truly passionate about. And the dirty secret about again going to graduate school and when you get an MBA in the US, don't kid. Everybody will like say, yeah, it's all about the school that you go to in terms of the culture, the student body. It's like no, everybody looks at what's the salary that you're going to get when you graduate. That's like the first anchoring, and that's how a lot of schools move up and down the rankings. Sure, there's other aspects of specialization. If you're going to get into oil and gas, you go to someplace in Texas. Generally speaking, if your investment banking is probably better for you to be on the East Coast, just because there's just more tied in industries from that perspective. But at the end of the day, most people are looking at, hey, how much money am I going to make? And so tying this back to kind of the professional journey is all of a sudden when you start to store your time and excess productivity in a better form of money, you say, wow, I need to be able to go build in this space. And I think ultimately I made that transition of seeing what was being built currently in the Bitcoin ecosystem and said, there's this leap that we're going to have to go make um, to make this technology of commercial grade, enterprise grade. And yes, there's a great libertarian aspect of, again, being able to go tinker and go build smaller decentralized systems. But there's also this concept of if this is going to become the world reserve currency, or even a meaningful asset that holds 10 to 20% of the world's global, again, value, we need to have technology that can ultimately support it. And I think that's where, my motivation came to get into the space was, yes, there's an adoption component, but there's also, I've been in infrastructure and building tech companies and, alongside a lot of founders for many years. I can go help do that. And that's where my time can be best spent. And so ultimately the goal is getting the people to use Bitcoin, understand the value, but then have the rails so they can have all of the beautiful characteristics of multi-sig, all these other different features without them having to, again, go through a ton of hurdles to ultimately adopt the asset. And so ultimately that's where I think a lot of my time and, our time at our firm is spent really focusing on how do we find those opportunities and ultimately go build out solutions that can be scaled across, again, everywhere from the single individual to the Fortune 5 company that's ultimately going to be adopting this asset eventually.
Yeah, so you're basically saying there's a lot of work done at the grassroots level, but what got you motivated is to get the work done at the institutional level. So you want to kind of build the infrastructure to support the institutionalization of Bitcoin. Because one thing that a lot of Bitcoiners fail to see, when you say institutions, everyone's like, oh no, you're a sellout or you're serving the wrong market. But the reality is, when you're serving an institution, i.e., a pension plan, the service you're providing to that pension plan is actually a service being provided to tens of thousands of employees for that pension plan. So think of it as, targeting institutions like targeting buckets of individuals at one time. And typically, the reason why it's so difficult to target this segment is because you need really strong, robust, reliant infrastructure. And I think that's been one of the major problems within the Bitcoin ecosystem. We haven't seen the huge institutional adoption because there's no infrastructure there. So that's really interesting. Maybe we segue into, VC. We know a little bit about early riders already, but before we get into early riders, maybe you can touch on some of the problems of traditional venture capital and why you and the early riders team decided to take on a different angle and use Bitcoin as your hurdle rate.
Yeah, I think I think a lot of us, what's great about the core partnership at Early Riders is a lot of us are, again, pure play builders. So again, we've been in the risk chairs, been given budgets, been given bogeys to go build, again, organizations or orgs to go achieve a specific revenue number. And so I think that's very different, I think, than a lot of, venture capital firms that have been out there in the past where, yeah, you have large funds that, again, have some individuals, but I think largely speaking, like, all of us enjoy getting our hands dirty. So that's kind of one component of which is very unique. I think the other component is a lot of us ultimately were products of, we'll call it the late 20 teens, so like 2017 to 2021, where you saw peak VC like craziness. Michael Tanguma at WeWork, he might, and we joke that he might take the cake on, again, it's Mount Olympus of capital destruction. I myself was at other companies, specifically at an organization that raised $750 million, so $775 million. Eventually achieved a $300 billion valuation, and then that thing has to be, again, these days probably written down. It's probably 20% of the overall value now, and so I think seeing all of the way that, again, this was working through that time frame, knowing that it didn't make sense, and then ultimately you see all the impacts on the back end of that. And so there was a concept that Reid Hoffman from LinkedIn talked about, which was blitzscaling, which was, again, raising large amounts of money, finding that product market fit, scaling incredibly fast, just, again, lighting money effectively on fire. And it always went contra to my ethos of where I started as a small entrepreneur. where we knew what all of our products were landed, when we would import them again into Long Beach, and we had to be very cost conscious. But all of a sudden, you have huge parties because people raise a ton of money. It becomes this big kind of boondoggle and hoopla. And I think that's something that is embedded deeply within our firm, um, because the the bad impacts of again doing that is you have large layoffs. You ultimately have to go pay the piper, and unfortunately, when interest rates are zero, there is no hurdle rate. Effectively, every company becomes worth an infinite amount of money. I mean, a discount rate is zero. Again, it's been a long time since I've done a DCF model, but if the discount rate's zero, that effectively means this thing can run for a long time in terms of how you value the organization based upon the revenues. And so I think that's something that's embedded deeply within early riders. Um, yes, we do use Bitcoin again as how we measure opportunity costs. But at the end of the day, we also believe that when you're building businesses on a Bitcoin standard, it changes the incentive model where imagine a company where you give them a bad store of value where they have to get rid of the money as quickly as possible and what that impacts the founder in the decisions that they got to go make versus you give founder money that doesn't lose its value. Like that is a complete 180 in terms of how they're actually going to go build higher scale. And I think when you start to kind of look at how that's been different from the last really 7 years of venture capital, 10 years of venture capital, and what we're going to look at going forward, you're going to see a dramatic change in overall size, funding sizes, and we're starting to see some of the themes that we've talked about for the last year and a half starting to come into the mainstream through again the more mainstream venture capital saying you don't need quite as much, you can actually operate with a lot less, you can again do a lot more. And so I think again, at the end of the day, we're in a very transitionary time. And again, we really view ourselves on the cutting edge of that from business building, and we're excited to see where our businesses continue to thrive and succeed because they're adopting those types of mentalities.
So you worked out that Bitcoin fixes those inefficiencies. There's the capital destruction and the peak VC model that you saw. How do you then pick a winner? How do you separate the winners from the hype?
Yeah, so I think it really there's a few concepts. Number one is we definitely take a position sizing component. So we at our firm we are very focused on getting deep with the founders because there is a mentality in a specific way to go build a business versus I'm going to go raise $15 million and I'm going to go deploy the first $5 million on just hiring completely. We take a very contra component of that where it's utilize the partners here at early riders, go build. But effectively, what we really see within Bitcoin is when we are evaluating deals is can this business actually scale without very 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 heavy capital components. So we're not going to be looking at companies that ultimately are going into again pure play mining infrastructure in terms of buying hardware, large capital expenditure. That's not necessarily our bag, but we do find that within the companies that we are investing in that it is a lot more in the infrastructure software layer, but then also middleware. And so being able to create this piping that is ultimately going to have throughput. And that's really where we see a ton of value and opportunity, going longer term, because it's, if we're building again, financial rails for the next, 150, 200 years, it's important that again, we find the ways that we can plug intermediaries, institutions, consumers into this network. And so that's really how we evaluate TAMs and various opportunities is really it's more based on software versus we'll call it hardcore, capital expenditure on infrastructure.
Yeah, that's very interesting. And it seems to align well with so early riders philosophy and your philosophy seems to bode well with the flourishing of AI. Because if you guys are, being cost efficient, cost effective, you're staying as lean as possible, and you mentioned, how typically founders would go and hire 10, 15 employees at a time to, scale up as quickly as possible. Well, now you could pretty much have that, but at a fraction of a cost with a variety of, AI tools at your disposal. So do you think that's something we'll see more and more within your bird's eye view of the Bitcoin ecosystem, Is it a trend where a lot of Bitcoin companies will start to leverage and use extensively AI to, outperform Bitcoin's hurdle rate, to facilitate the outperformance of Bitcoin's hurdle rate?
It's no longer. Let's ignore Bitcoin for the moment. Like, let's just look at pure play venture capital. Like, it is it is a requirement, or again, VC firms will legitimately have to have massive markdowns in the way that they're again approaching their portfolio, and these companies have to adopt these strategies. I'll give you an example. So again, like everybody talked about like DeepSeek, and they're like, oh wow, like again, like they built this AI model at the fraction of the cost, and like again, whether or not it was $5 to $6 million, that's largely irrelevant. Even if it was 60 million or 600, based upon the relative amount of money that was spent from OpenAI, again, the closed source models, it's an incredible amount of deflation that's occurred there. But what really struck me was the acceleration of capital destruction. That's what to me is incredibly under, it's not talked about nearly as much. Where, okay, we had these models come out in the last couple of years, but all of a sudden you see DeepSeek come out at a fraction of the cost, or at least reportedly. Ultimately, that took a couple of years. Now, when I look back and I look at the timeline on when I was at a former company, we raised a ton of money, $750 million. You have the big hype cycle, then ultimately drop. That was like 7 to 8 years. So you're seeing this now acceleration of capital destruction. So now VCs themselves have to become one increasingly more discerning on how they go deploy the capital, and also how do they measure the opportunity cost, or what is their effective hurdle rate? Because if that's accelerating and these AI tools are becoming that much better, then ultimately these companies are going to be adopting these technologies and being able to, again, spin out revenue even faster. And so there's going to be this push and pull where you're going to see VCs that ultimately are seeing massive markdowns because I think they're using the wrong cost of capital. They're using dollars, or again, some, SOFR rate or some hurdle rate that, is effectively inadequate, when in reality they should be using something like Bitcoin and keeping the Bitcoin in their treasury as a venture capital firm. Or again, they do capital calls based upon, again, measuring Bitcoin on their hurdle rate, and then they're deploying it within to the businesses. And so that's, to me, is like something that's not talked about nearly as much, is just the acceleration of the capital destruction. It's happening faster. And again, we're going through a cycle here in the US where we're trying to get more efficient as a nation, but we know it's cooked. Like, again, there's only so much that Doge can do. There's only so much that, again, we can do as a nation to make it more efficient. We're going to have to go debase the currency at some point. And I think there's going to be a lot of, again, moving of, again, the proverbial poker chips on the table to ultimately make that as pain-free as possible. But again, there's going to be quite a bit of pain from that perspective.
Yeah, so you talked about capital destruction and VCs. What about the wider institutional landscape? Is institutional money coming or not? We hear about institutions entering Bitcoin, but what's the real numbers here? And if they're not adopting it in scale, then what's stopping them?
So I will say institutions are now this asset class is no longer radioactive.
Yeah,
I think if we've been in the space long enough, it's been a challenge to talk to anybody from traditional finance. Yes, we're fortunate enough to get folks, Harris, like yourself, Ralph, that grok the asset and decide to make a move, and again, into the Bitcoin ecosystem. But largely speaking, for since I jumped in 2017, not a lot of people even recognized it as a legitimate asset class. So it's now being considered, I think, obviously, with everything that's happened stateside, strategic Bitcoin reserve, better legislation, more friendly, administration. Institutions now we're getting more calls from institutions, again, looking to just learn more about how can we allocate to this asset class. But again, we talked about legal debt prior. There are hurdles that they got to go get through, or there's funky structures that they ultimately need to go find a unique way to get access to the asset class. One could be that they have to go spin up an SPV, and then ultimately that SPV can go get exposure. Or again, there's a lot of different ways that they might not be able to access it. But that being said, with the U.S. announcing the strategic Bitcoin reserve, I thought the wording was brilliant. I thought it was actually really well done. everybody really wanted the government to go like again do a hard smash buy on a Tuesday for Bitcoin. And it's like, sorry, that's really not how this is probably going to work. What we're going to have to go figure out is get legislation. Let's get it passed through Congress and the Senate, make sure that can actually stick. But what that does, I think, is again, it's that reverberation through the entire globe to say, okay, great. Now every country needs to be considering this. At least it's on their radar. Now, again, in Ralph, it's part of the world. I think the UAE and again, Middle Eastern nations have been much more open to this. One, because they don't necessarily have the legal debt that we have here some of the West. It's more or less, hey, this is a monarchy, and we can go sign what we want to go
Yeah,
sign for these sovereign wealth funds,
very true.
which is just a different component. And so I think what that does though in the US is it gives every single nation around the world the ability to go take a look at the asset class. The Middle East is going to be leading again from a regulatory perspective, I see for the foreseeable future. But the US is now going to ultimately start to be putting their foot on the gas to be chasing. And what that does is it again prevents everything that happens in traditional finance when it comes to career risk. Don, the portfolio manager managing, $100 billion, he's got his kids in private school, again, has all a specific lifestyle. It ultimately eliminates that career risk. And we can start to go dip our toes into those 1, 2, 3, 5% allocations. And that can be a funds of funds. And I think that's really where we'll start to see it is, some of these other folks coming in and saying, hey, you can get asset exposure to this asset class. And we'll start to see them really start to just see it as, let's go get some picks and shovels. Some will ultimately allocate to spot. Family offices are far ahead. They're getting involved. And again, that'll continue to start to be adopted here, in the near term. So,
Yeah, that's great.
Go ahead, Rob.
Oh, no, I just want to, we're talking about Bitcoin Strategic Reserve. There's rumors that China now is considering to enter the race. It seems like, the United States triggered something that was potentially being discussed behind closed door to now reverberate more publicly. We have Russia also stepping on the gas pedal for settlement in crypto or Bitcoin related assets. But that's great. Regulation was always a threat. It seems that that is a risk that is behind us or behind Bitcoin. There was a few other risks, for example, changing the code. But in 2017, the block wars kind of proved that that risk is potentially behind us as well, because since 2017, since the block size war, Bitcoin has grown in adoption. There's more people running their own nodes. So it seems that risk has also been diminished. Brad, in your opinion, you are helping build Bitcoin infrastructure. What is the biggest risk or threat to Bitcoin right now? It's a
I
tough
think
one,
there's,
but
I think,
yeah.
I think there's two. I think there's two, and again, there's really one that sticks out to me, and it's not one that I think is talked about often, and it might be a pretty contrarian take. Um, to me, it's the price of Bitcoin
Uh,
because
yeah.
you can't build businesses without people,
Mm.
and I think yes, Bitcoin does allow for again individuals to store their value in a better form of money. But a challenge becomes is if that number runs too fast, too hard. There is always an incentive to go like again. The only thing more finite than Bitcoin is time on this planet, and again, really wanting to again enjoy that time. But again, at this the other side of the coin is if it runs too hard, too fast. Again, we need to continue to attract again smart, intelligent people into the space. I think again, like we're in a really great position with again the regulatory landscape to continue to do that. But we are human beings at the end of the day. I love to be building. I will plan on building for a long time. Um, but I think there is a large cohort of people that are, again, number go up. I will ultimately exit and, go on my land or go to my compound and kind of do my thing. And so I think to me, yes, we might have more institutions that come in, but again, like we need to maintain a strong community of Bitcoiners that I think respect the understanding that yes, institutions will be involved, but again, like that are there to reinforce the original rules of what Satoshi's vision was, which was a permissionless store of value that can be sent, anywhere over the world at any given point in time. And so I think that to me is a risk that, I maybe not near term, but I think, over the longer term, it can certainly it can certainly start to proliferate as something that could be more people being less involved in the space, and that to me is a risk for anything. So
Yeah, preserving that core ideology is so important for the survival of Bitcoin. I agree with that. So, what about fiat? Do you think fiat will survive the next 50 years? And if you had to bet, do you see the fiat system collapsing in our lifetime?
it's funny. And maybe I was overzealous. I made a bet with it wasn't even a bet. It was maybe a call with a close family member of mine, and it was about the euro. And this was back, I think, in probably 2019, 2020. And I mean, again, I've always been skeptical on like the survival again timeline of the euro. Um, I think that we will see massive currency shifting. Um, I think fiat itself, is fiat a stable coin? There's arguments to be made on both sides of that. I
Hmm.
think regardless, we are always going to transact we're for at least our lifetimes, a less, um, I don't know, reliable store value form of, currency. Um, Again, I think that there's just too many large institutions, strengths, individuals at the helm that will make that something that needs to make kind of maintain its standardization. Now, we could see a lot of nations consolidating, adopting some sort of stable coin. I think that's something that could happen very much so in the near term because I mean, imagine being at a central bank of a third world country. Like the incentive to stay on your currency
Yeah.
really, there's not a lot, again, there's just not a lot for it. Because it's such a damaging scenario for your people, particularly as the dollar continues to go through volatile fluctuations of being very strong and then getting weaker. So I think again, fiat itself, um, it will just change, and I think it changes into some sort of form of digitization. But I think that yeah, I would be willing to bet in the next 5 to 10 years you will see a major currency. I think it's euro yen, um, something along those lines. There will be a dramatic shift there, just because of the nature of the way that credit-based system is set up and how it's becoming increasingly fragile. The euro is the one that I think is the most fragile at this point. Japan has somehow been able to stay alive for however long it's been, but I think a lot of that's just due to swap lines and things like us being able to support them from that perspective. So, yeah.
Yeah, I like what you said about there will, for the foreseeable future, always be a need to use a less hard asset as your, kind of day to day while you save in the harder asset. And I think that's something that we've witnessed throughout history with the bimetallic, silver, gold. Silver was much more easily manipulated than gold, copper as well as part of the mix. I think that's just normal. People will want to keep on to what they value the most, the strongest purchasing power, and just dispense of, it's like me when I travel, if I have, uh, Canadian dollars and US dollars, I'm going to try to get rid of the Canadian dollars before I get rid of the US. And, these are two really bad currencies over the long term, both of them. But for a Canadian, it's like, no, I'll keep the dollars. Even if, I'm not going to spend it, I still rather keep the dollar if I'm going to hold on to it for a few months
Yeah.
versus keep, the same $100 in Canadian dollars. So yeah, one thing. So we're getting close to the finish line. Uh, I'll ask you one question before Harris wraps it up. But what would you give as advice to your younger self? But thinking that you haven't discovered Bitcoin yet, right?
Yeah, advice to my younger self before Bitcoin. Um, I
You can't
think
say buy more Bitcoin.
Yeah, go back to
oh no,
2009 and
that's
start.
that's every
Yeah.
Bitcoiner's dream. That's every Bitcoiner's dream. I think I think lean into your interests. I think particularly in the US, um, we've really streamlined the way that we make again our children go through again kind of the life cycle of again their childhood into their younger your teenage years, and then ultimately they go away from home, university, whatever it is. And I think now that we do have Bitcoin, and again this is a little bit in hindsight, but I would say lean into the interest that you love, because I think, we're going to be entering a space, that you can actually get to have your time be valued versus, in the US, it was always go to college, get a degree, have it be, in a hard type, again, subject, whether it be engineering, finance, accounting, business. Um, but I think that also sucks the soul out of a lot of cultures and societies. And so what I would say is, like, again, just for me, if I was, talking to my 18-year-old self, is just like lean into something that you ultimately love. I'm fortunate where I'm naturally curious. And so I have a lot of hobbies, and have enjoyed, again, my career just being able to go build things. But I do know a lot of my, again, other friends, colleagues, took a path just because, like, that was stable. And I think a lot of that is due to just like bad incentives of money. And, I think we could have a lot more of a flourishing culture society if folks actually really lean into what they, are truly passionate about. And we're rewarded for that. And I think hard money, standard gets us there. And, unfortunately, that's just kind of the game that we were born into. And, you folks probably listening to this podcast, I think, are, again, they're on a sound money standard, I would hope, and or at least they're curious about it. And so I think, yeah, it would just be, lean into something that you love versus, doing something that because that's what we've set up. So
I think that's excellent advice. Lean into your interests, and actually, it echoes something that I read by someone called David Graeber, quite a famous anthropologist. I know he's not the typical person that a Bitcoiner would quote because he's very much the opposite of a free market capitalist, as it were. But I think there's some very good advice he gives, because he bemoaned the proliferation of BS jobs in society, and a lot of those BS jobs have been created because capital allocation is so inefficient. So you have, it doesn't matter if it's private sector or public sector, money is just poorly allocated. And as a result, it's created these jobs that just are box ticking exercises and don't really need to exist, especially and including within the private sector. So I think that's excellent advice. Lean into your interests. We're at the end of this pod, and we thank you very much, Brad, for joining us. Where can people find out more about you and Early Riders?
yeah, no, earlyriders.com. You can go to our website. We have a contact form there. Feel free to reach out to us. We'd be happy to, again, speak with anybody that's interested. Early_riders on X or Twitter. And you can follow me at jbradmyers, MYERS on X. Reach out, send us a note. We would love to connect, whether you're a founder, entrepreneur, someone interested within the ecosystem. We get tons of inbounds from really high, top-notch professionals. Again, folks at investment banks, corporate consulting, that are just looking to find people to talk to about Bitcoin. And I think it's amazing when you put that bat signal out, is, again, the community and, again, some of the culture that you can go generate, and the discussions that you have. So folks listening to the podcast, if you're in, again, a traditional, again, focus area, do not hesitate to reach out. We see a ton of people reach out that are, again, starting to want to learn more about Bitcoin, want to maybe see how they can get involved, whether that be, within Early Riders or, again, even external to that, found their own business. We're happy to have a discussion and take time out of our day, because it's important that we continue to get quality builders in the space and people interested, because ultimately, without the people building on Bitcoin, Bitcoin will go away. So.
Wonderful. Well, thank you again, Brad. Thank you for your time today. It was a fascinating discussion. And thank you from myself and Ralph to our viewers for joining us, and we'll see you on the next episode.
Thanks, everyone.
Thank you.